Okay, hi there. Welcome back. We're looking at the effects of economics of currencies and things, exchange rate movements. Let's spend a few minutes, if it's okay with you, looking at the consequences of a currency appreciation. Now, the example we've been using is Mexico. It's been one of the strongest currencies globally in the last year or so. You can see here the value of the peso has gone up against the dollar, meaning you have to give up fewer peso to buy $1. So go back to 2020. To give up 23, 24 peso to the dollar. It's now down to sort of 16, 17. And if that continues, it could go down to, let's say, 15. So the purchasing power of the peso in the foreign exchange markets has gone up. Conversely, Americans converting dollars into peso, they get fewer peso than they did before. So the peso has definitely appreciated. And the question here is, give me three macroeconomic effects of an appreciation in the Mexican currency versus the US dollar. Lots of things we could talk about. Here are three things that I've chosen. Hopefully this will be useful for you. First of all, remittances. Now we know that Mexico is highly dependent on remittances, something like 5% of their GDP, something like $55-60 billion a year coming to Mexico from people living and working overseas, sending remittances back to Mexico City, for example. If the peso appreciates, then the real value of those remittances in terms of the local currency will go down because you're converting dollars into peso. So instead of converting $1 and getting 23, you're converting $1 now and getting 17. So it means that the Mexican economy, which is quite highly dependent on remittances, will take a little bit of a hit there. On the other hand, a strong appreciating peso makes it cheaper for Mexico to import the things it needs, including things like food and fuel. So the balance of trade might improve. And if you think about Mexican growth and development prospects, they've got some pretty expensive, ambitious transport and refining infrastructure projects to drive growth. Well, a strong exchange rate makes it cheaper to import the capital, the technology, the hardware that might be needed to complete those projects. So it might make it slightly easier for the Mexican government to deliver infrastructure projects on budget if the exchange rate is strong. And another consequence could be disinflation. So Mexico's inflation isn't as high as it used to be, but a combination of rising interest rates set by the central bank and a stronger exchange rate, of those two factors together should help to bring down inflation, to create some disinflation in the Mexico economy. Higher interest rates reduces aggregate demand, and a strong exchange rate reduces import prices. So if inflation comes down in Mexico, one of the side effects could be that real wages might start going up. For a given nominal wage increase, the real wage will be affected by that. And secondly, it might also cause a fall in bond yields. You see, if you have a strong exchange rate and low inflation, the Mexican government, in theory, should be able to borrow money at a slightly lower yield than if you have high inflation, economic instability, and a weak exchange rate. So there we go. We've spent a few minutes there thinking about some of the consequences of a currency appreciation. Hope you found this useful, and take care. See you soon.